SBI mutual fund who is joining in now. Ruchit, good morning. Thank you for joining in. Sticking to what Abhishek was mentioning about the large private banks. What do you make of the numbers? Kotak is not seeing a very good reaction to its results, but HDFC Bank and ICICI Bank both surprised the street on the positive. So, what's your call here on large private banks? Do you stick to the leaders? Do you find value in the smaller names?
I think traditionally we've been liking the larger private banks a lot better. I think even in the current environment that's there, we think that the private banks should see an improvement in their growth prospects. Particularly, I think from a margin standpoint, I think the private banks could do a little bit better than the public sector banks, given the way the pricing of the deposits and the loans would be. The public sector banks would likely see a bit more pressure on NIMs compared to what the private sector banks will do. So, from a sectoral perspective, we like the banking space overall, but within that, I think the private banks could do better than the public sector banks. But even within the public sector banks, you have some of the larger names which kind of would do well going forward as well. We've not so positive about a lot of the tier two or tier three banking names. And there are a lot of individual challenges, be it with regards to overall growth prospects or in terms of management, quality, etc. So I think it's better off to stick to the larger names within the banking space overall.
Ruchit, you want to tell us the top picks in the larger banks? We've got a Kotak, SBI, if you add, the PSU heavyweight there, ICICI Bank, HDFC Bank, and Axis. Which one would you recommend now?
I wouldn't go name specific, but I think you can be more on the private sector and the larger public sector banks. Overall, we have been more positive on the banking sector per se. Growth has been fine. I think ROEs have been fine. The sector has underperformed over the last 3 years, and if you think of all of the metrics, the banks have been doing reasonably well. So I think this year they have seen a bit of an outperformance, and we think that they should continue to outperform the market overall.
The other big story, Ruchit, this morning has been oil, and it's been on the declines from almost around $75-80 at the start of April. We are now sub 60, and this has had a windfall for our own economy as well. But what about stocks in this oil sensitives basket? Where do you position yourself? You position yourselves among the OMCs, or you still believe that stocks like ONGC, Oil India will still recover from this? Or would you find other oil sensitives, say paints or tires or even aviation for that matter? Where do you place yourself?
I think in a falling oil environment, you obviously want to be with the companies which are going to be using oil as an input. So, as you mentioned about whether it's the paint sector or the aviation sector, more so because they will see probably lower cost and, may be able to expand their margins. But in terms of the oil companies per se, I think the oil marketing companies traditionally seem to have not seen material benefits either on the upside or on the downside when oil prices have moved. They should be able to report reasonably okay set of numbers. Some of the profit expansion right now that could occur because of the fall in oil prices could help them recover some of the losses that they made previously with regards to certain commodities like LPG, etc. So by and large, they should be okay. Players like ONGC, etc., will obviously see a decline in their earnings, considering that they are more directly sensitive to oil prices per se. So I think you're better off seeing the decline in oil prices to participate and look at investing into companies which are beneficiaries of the commodity rather than sort of the commodity producers themselves.
What else are you bullish on? I mean, if you had to construct a portfolio today, Ruchit, how would you go about doing that? What would your bias lie towards, and the sectors that you would avoid or themes?
So we've been positive on the financial sector per se.
You said that, yeah.
That's one area. The second is that anything to do with domestic consumption. I think in the current market environment, in a domestic place will do far better than any company or any sector that's more export oriented, especially given the degree of uncertainty that's out there, right? If you are exporting to the US, Right now, there is a high degree of uncertainty whether you will have the ability to export or not, whether there's demand itself or not. So there's a lot of question marks on export-oriented names. So we've been a lot more cautious on that part of the market. I think you're better off being focused more on domestic-oriented names, particularly domestic consumption names, and more so on the domestic consumer discretionary side of it, right? And I think a variety of factors. You have modest, improving economic growth, some bit of early signs that perhaps the rural economy is doing a lot better. Income growth there has been fairly fine. You have these tax cuts which are now kicked in, so everybody is likely getting about anywhere from 90,000 or give or take on average as a tax cut that's there, and that likely could boost some of the domestic consumption that's there. So I think domestic consumer discretionary names per se look fine. I think some of the infrastructure names also look fine. I think sectors like cement, etc. They've faced a lot of input cost pressures. There has been some bit of demand weakness as well, but the sector started to consolidate quite a bit. You're seeing some bit of recovery in the demand. Government spending on capex has started to improve as well. So these are areas that could do well. Overall, infrastructure, capital goods, engineering, yeah, broadly they look fine. I think from a demand perspective, things look okay. Valuations are obviously expensive. They are factoring in a lot of growth that's there, and therefore one has to be cautious with regards to the mismatch between expectations versus what can actually be delivered by these companies.
All right, Ruchit, thank you so much for sparing time and joining us today. Looking forward to having you more often on the platform. That is Ruchit Mehta of SBI Mutual Fund. By the way, the Nifty slightly off the highs, now 120 points higher, now at 24,470. Take a short break. On the other side, we continue corporate conversations. Anand Agarwal, the CFO of V-Mart Retail, joins in to discuss the road ahead for the company. Stay tuned.